Hi, I'm Peter Grant. I founded Grant Property 20 years ago with my wife Colette, and I guess you're watching this movie because you're already interested in investing in residential property. So I'd like to explain a little bit about what we do, what our approach is, and how we help clients invest. Okay, so what I'd like to do is to take you through some slides just to explain how the whole thing works. And that should take about maybe 10 or 15 minutes or so. Okay, so looking at the market first of all, there's a simple graph showing the stock market and the property over the last 30-40 years since records began in the early 1980s from a property point of view. And there's two main reasons why someone would invest in property. One is that the average returns have been 28% per annum. So that's the average capital appreciation over the last 30, 40 years has been 7% per annum. So when you're geared, which is quite normal in property, then the average returns per annum have been 28%. So that's big reason number one. And the second reason is that there's really very low volatility in the property compared to the stock market. So, okay, stock market, get on at the right time, it works very well, but equally property doesn't have the volatility and it's much more predictable, if you like. As an investment, this is a great slide. I think it came from the Daily Telegraph, and it just shows the different asset classes. It was taken from a bit of research that was carried out, and it's just another way of looking how property compares, and obviously residential has outperformed commercial and every other asset class, and with gearing it's performed spectacularly well. There are some downsides to property, and they really are the fact that, first of all, it's very, very time intensive. So if you've ever got involved with even trying to find a house to buy or find a house to rent, then it takes an awful lot of time and effort. But take the cumulative of everything in terms of what you do as a property investor, then it really is very time intensive. There's lots of issues to manage, so regulations are high and ever increasing. They actually vary from one city to another, so you've got to really know what you're doing. And generally there's poor sector regulation. There's been a lot of talk in the press, and particularly in England, about the very poor regulation. So you've got a lot of rogue landlords that are in the market, and the barriers to entry, whether you're a landlord or whether you're a property management company, are very, very low. So you tend to find some poor quality around the place, whether it's stock or the level of management. So what I'd like to do is to explain about our suggested way of going about building a good portfolio of properties. It might be a portfolio of one or two, but it might be a portfolio of a much larger number than that. So we're going to tell you a little bit about us and what we do and how we do it, a little bit about the market, and a little bit about the things to get right and to really focus on, as it were. We were founded in 1997, I suppose by accident in some ways, because we bought one property as an investment ourselves, and from there we've actually gone on to build a portfolio of about 70 properties. So we've done it, we understand it from an investor's point of view as well as from a company's point of view, helping clients. But from there we kind of grew up, the business took off. Early clients were friends, then friends of friends came along, and from that the company's grown to have clients in probably 30 countries around the world today. And we've helped people invest over 2,000 times, and our coverage is across 12 cities. So we're not particularly focused on one city. We understand the good and bad of all 12 cities that we go to. What we try and do is to give a complete end-to-end solution, so a kind of one-stop shop. So you as an investor can basically use us for sourcing the right kind of properties, for renovating them, furnishing them, then doing the ongoing management. And when clients have got a group of properties, then obviously we can help with the management of their portfolio of properties also. This slide is a little bit about our values. You can see more information about that from our website. But fundamentally, at the heart of everything is the client. And what we try and do is to make sure that the client experience is good. So our model works by happy clients coming back and buying again, and for that matter, telling their friends, and so word spreads, and that's the sort of core DNA, which implies that we've got to do a fairly good job, otherwise that would break down. The market itself is really, really interesting, and if you take the early, when the stats properly started in 1983, and it doesn't matter whether you look at the Halifax or the nationwide index in blue and orange there, the direction of travel is basically in one direction. Now, there have been periods where it's been more flat, such as the early sort of 1990s when there was a recession, and then more recently we had the financial crisis in 2008, which dragged on for a number of years. And what happened there was that the financial crisis was really interesting because the banks stopped lending basically, and so that had a massive impact negative on the whole property sector. But nonetheless, property prices only fell by around 20%, and they recovered fairly quickly to about half of that deficit, and then they went flat for a number of years, and now the direction of travel is very positive again. So the average capital appreciation has been 7% per annum across the whole piece, and we're now at the point where we're outperforming that average trend, and prices are going up by greater than 7%. And that's been helped by government policy. So the government's done a number of measures to try and get the economy going, and they've 2 years ago flagged that they're very interested in trying to help house builders recover, first-time buyers, and refinancing the banks and so on. So there are three obvious ways of sort of warming up the market, and that certainly has had a positive impact. But equally, what's likely to happen is that they're going to take other measures looking forward to hold the price growth at a steady and sustainable level, probably in line with the long-term average. And happily, we're at the point where actually we're at the start of a very interesting part in the cycle. We've come out of recession and we're heading to growth. So this is actually quite a good time to invest and get into the market. Looking at the returns on property, there's two elements to look at. The first one is house prices, and we've already talked about the long-term average growth is 7% per annum, so the overall returns there when geared are 28%. London prices are seen as a bit of a problem. London raced ahead during the financial crisis, fueled by overseas money coming in, and so London behaved in a different way over the last 5-6 years, and it's been racing ahead, it's now more flat. And outside London, in the regions outside London and the southeast, what we're finding is that prices are now racing ahead and, if you like, catching up. But you can still get great value because you can currently buy at 2007 prices. So the opportunity really lies there. The second aspect is to do with the rental market. As long as I've been around, there's been a fantastic, strong rental market. Within the rental market, the student sector is particularly interesting because it's such a large market, and obviously every large city has got a big university. Generally across the board, rents are rising, but within the student sector, there really has been a positive growth of rents over the last 2 years. So 2 years ago, we put our rents up by about 10% per annum, and more recently, this year, I think they're up by about 7% per annum. So there's a shortage of supply, there's huge demand, and rents are generally rising. This slide's quite good because it's almost like a dashboard of the different elements that comprise, what's happening in the economy. So the first line is to do with GDP, which is obviously doing pretty well. It's kind of forecast to be sort of good steady growth and probably the best performing country in Europe. Unemployment is falling and continues to fall, and consumer confidence is rising, which is really, really good. If you look at the banking side of things, then the latest statistics are that the buy-to-let lending is up by significantly by 33% year on year. Base rates are still at the low of 0.5%. They may rise sometime in 2016, but a lot of people predicting that the whole of 2016 will have base rates remaining at 0.5%. And mortgages are on the up. So the number of mortgage products as well as the amount of mortgage lending is up at ever increasing levels. So all of that in terms of impact on property means that the property prices are very positive, and this is one index, but the number of buyers per property is very high as well. So there's been a shortage of supply, with house builders not building anything really in any significant numbers since 2009. In fact, many of them went bust and stopped operating for a number of years. So there's been a shortage of supply, no new stock coming on, and now there's a large number of buyers chasing every property, causing prices to rise. So the price outlook is pretty positive. Different people have different views about it. I think it will be in line with the long-term average trend of 7% per annum. Headlines are also interesting because they have an impact on the way people perceive the market also. And generally speaking, I think every single headline that I see is positive around every aspect to do with the economy and the property market. So, next step slides are really about how to maximize performance and also looking at different property types and different property options that there are. This is a very, very simple slide, and it really explains what we do and why. So if you look at yields and yield performance, then London is in prime areas, it tends to be about 2% yield, sometimes even less than that. So that's a good reason why we don't personally go to London, just because the yield performance is so poor. If you look at new build generally across the UK outside London, then yields tend to be 4, maybe 5%. And the bit that we like are the traditional properties in the city centres, which tend to be in the better locations and which just perform better. So they're larger buildings, they're bigger rooms, higher ceilings, sometimes not dissimilar to this building I'm in here just now in terms of the type. So they perform, from a yield point of view, the absolute best. Top tips when investing would really be, I guess, number one thing to absolutely get right has to be location. So buying in the right area is absolutely key. Do not go and buy a bargain somewhere in the middle of nowhere or in the outskirts of the city or in a secondary location if you can possibly help it. Buy in the best locations, and best locations are ones where the highest rental demand is there also. The second thing is traditional property outperforms new builds, so we've already talked about that. So that would be top tip number 2. And the third thing, sometimes tied in with that, is to do with rentability. So again, choosing a property where you're going to get good yields and high occupancy is really, really important. Beware of people telling you that you'll get really good yields and really high occupancy if they're selling you something. So be cautious and do your own research. That would be my best advice. No matter where you're thinking about buying, do your own research independently of how quickly something rents out, what it actually rents out for, not what you're being told necessarily by someone that's trying to sell you a property. And then finally, and last but not least, I think, is buying well. And everyone wants to buy at a good price. So during the financial crisis, you were absolutely able to get bargains, no question about it. We're now in a more normal market again, where there's lots of buyer competition. So the sellers are really looking at trying to get the best price they can from a competitive situation. So our job is really to try and buy well, but not to compromise on the above things there. And finally, and most importantly, if you can tap into someone's experience, doesn't matter who it is, if they know and they've been through the hurdles already, then that will save you time and money. So in our case, where we've helped people 2,000 times, we've obviously accumulated a lot of knowledge and expertise, and that should save an investor time and money. Okay, the next and very important thing to look at is how to maximize performance, and bank finance really plays a big part in that. So to kind of give you an explanation of how the shape of the whole investment typically would work, then we can look at the following here. So what we're saying is that we're buying a property of value 250,000, and there's going to be a 75% loan to value gearing. Banks are kind of up to that level at the moment. Their sweet spot is anywhere between 65 and 75% in terms of loan to value. So the amount that you're putting in is 62,000 here. There's a setup cost of 15,000, which is the costs incurred with buying a property, stamp duty, furnishing, bank arrangement fees, etc. And then there's also the bit that you're borrowing. So you're borrowing 187,000 here. So in year one, or the next year that happens, as it were, values rise, let's say, by 7% in line with the long-term average. No reason why that shouldn't be the case. And you're paying off, let's say, £5,000 off your mortgage per annum. So the red bit's beginning to go down, the blue's beginning to increase, the yellow's been a one-off, it's not recurring. And then if you take that across a 10-year cycle, then what happens is that the property value goes up really quite significantly and almost doubles in value in a 10-year period. And obviously the amount of bank borrowing goes down. So the bit that you are sitting on in terms of equity is the blue bit here, which is great. And it's really interesting, this graph here, I try and show what happens versus gearing versus ungearing. I would always say to people that if you're about an investment, you're trying to make it work and maximise its performance, then you would always gear. So this is the same flat here. You're buying it at 250. You've got £250,000 worth of cash. So in scenario A, which is yellow, you're basically here buying one property, and it gradually goes up in value. So different scale, but the same graph as you've seen previously. The other scenario here is where you've got £250,000 of cash, but you use bank gearing. So actually you can buy 4 properties or thereabouts. And the cumulative impact positive of your cash working is really, really significant. And that is, in a nutshell, why almost all our clients will gear their properties, because you're just using someone else's cash to make the investment work as well as it possibly can. So there's 2 benefits. One is that you're buying 4 flats, perhaps even 5 depending on the value, versus 1 which is ungeared. And the second thing is that it's much more tax efficient also. So there's a double whammy and a double benefit that comes into using gearing, and I've grown my portfolio absolutely by being on the green line, as it were. Let's have a look at banks and the good and the bad of banks, as it were, and our top 5 tips. First of all, loan to values. The more gearing you've got within reason, the higher your performance and the better your return on cash. So banks will probably max out at about 80% in very good times. Right now, they're probably stuck somewhere between 65 and 75% loan to value. But that's one thing to focus on, and probably the most important thing. The second thing is service, and choosing a bank that actually delivers is really, really important, because right now, different banks have got different processes and breaks applied and so on. So we can point in the direction of the banks who have got a track record of delivery with our clients, and maybe give you a heads up about banks which are not quite as good as they might be at this point in the cycle. The third thing is interest only, and if you can give yourself the flexibility of deciding when you pay off your capital, that gives you just extra freedom. So there's 2 options. One is interest only, which I prefer personally, and the other one is interest and capital. So that's something just to give some consideration to as well. And then the other aspect is that not every bank actually will lend on the purchase price and then the renovation. So again, we can give you a heads up of which bank will be able to give you the best deal overall, if you like, as far as that's concerned. And certainly stack them up against any banks you would know as well. And then finally, pricing is also really important. Again, not as important as the other stuff. And the reason for that, I say that, is that right now, the most expensive bank today is 50% cheaper than the most expensive bank, than the cheapest bank before 2008. So money is really, really cheap, and even the most expensive bank is still excellent value today compared to what it was any time before 2008, when base rates were much, much higher. So those would be my top 5 tips. So let's look at now about how we make it happen. It's currently a very, very competitive market. So to work well with you, a clear brief from you really helps us understand what you're trying to achieve in terms of the types of property, in terms of the cities you're interested in, the prices and your timings and so on. And a fast decision is really, really helpful as well. So when we match a property up with what we think will work for you, if you can give us a fast yes, that's enormously helpful. And a fast no is equally helpful because we can then pass that property on to another client. And what we do as a business, as I've said right at the outset, is that we try and cover everything. So we buy properties and we source properties on market and off market every week. We then renovate on a fixed price, so we take the renovation risk, and we do that in an 8-week period. We furnish it, and we do the rental and management. So we kind of try and give a complete solution. So it doesn't matter if you're living in Edinburgh or you're living in Hong Kong or Qatar or Singapore. Bottom line is we try and cover absolutely everything for you. To drill down to some of that, the way the buyers work is that they look at obviously only the prime areas. We wouldn't really consider secondary areas as part of what we do. And we consider every property every week that comes on the market every week. And we quite often get properties coming to us off market because people know we're a big buyer of properties for our investors and so on. So we consider everything. And then we evaluate the ones that are shortlisted. So we'll go into a property and we'll assess it fully and take a note of everything that's required and put it into an investment model. And that will give us the guidelines of what something's going to cost, and therefore we can give a fixed price on that, for example. So new kitchen, new bathroom, central heating system, etc., etc. And then we get the values from an independent RICS qualified surveyor, so that it's someone independent that says that's the value in its current condition and that's the value once it's been fully renovated. So that gives us all that information. And then from there, we've got all the facts that allow us to go and negotiate on the price and ensure good value from the sellers, as it were. And we will only put forward the properties which actually work. We'll never put forward properties which are marginal or just don't work from a yield point of view or an investment point of view. The way we renovate is that the project manager who is employed by us in-house will control a set of tradesmen in a property, and as I say, we do that in 8 weeks. We actually do it in 6 weeks, and it's just a process. This is what happens in week 1, that's what happens in week 2, etc., etc. But the project manager controls pretty much everything from getting the architect's plans and getting the consent and the building warrants, working with specialist contractors if that's required. And we typically put in a new kitchen, new bathroom, new central heating system, rewire a property and then decorate it and furnish it. We do all that, as I say, in 6 weeks. Well, we say 8 weeks, but we actually do it in 6 weeks. There's a couple of tricks that we have. So here you can see a situation whereby we've got a large flat, Sanctuary one in Glasgow, bought quite a while ago now, very, very large flat. And what we've done is we've moved the kitchen, which was here, into the centre of the building more, which creates another bedroom here. And this room here, which has got 2 windows in it, it's a very, very large room, lends itself to being configured as being basically 2 bedrooms. So some of that is done as a box of tricks to increase the value, but some of it also will increase the yield. So different properties will be, every property will be different no matter which city you're in. So everyone's unique, but those are the general things that we might do with configuration and layout. Obviously, room sizes have to be adequate for that kind of thing to happen. And to bring this into some kind of a focus now, this is a kind of case study. So this is almost taking the worst case scenario. So we'd very rarely buy a property as expensive as £300,000, but let's see how the numbers work even in that. So this is one we bought in Edinburgh, in Marchmont, which is one of the prime rental areas in Edinburgh. quite a large property. We bought it for 300,000, and once it's renovated, it's worth 340,000. So value is up by 40,000. And because we can do the renovations for 40,000, it kind of makes sense. The impact on the rent is really interesting because it really moves the rent up quite significantly by putting a new build interior effectively into a property. The impact therefore on the yield, taking all of that into account, moves it from something that's under 4% to a yield that's basically 6%. So that's a significant increase. On the furnishing side, we tend to try and get furniture which is not too expensive but equally as durable. So it tends to be hotel style furniture which we buy directly from the factory, and we've even given a name to the latest sort of specification that we work to, which is Aspen. And basically these are properties which end up looking fantastic, for which there's really, really high demand, and certainly a hell of a lot better than when I was a student, albeit a few years ago, and considering what I used to live in. So, you know, we try and really produce a really, really good product is the bottom line. From a management point of view, any management company should absolutely take care of all the safety and compliance issues, and there's lots of them. So there are many, many management companies. In our case, we are, because we're first and foremost investors ourselves, we kind of structured the company to have a very, very high focus on occupancy and making sure the flats are rented. So we will do things which no other management company will do. We will rent flats in January for occupancy, in August when the lease terminates for the previous tenants, as it were. And within that also we're Arla qualified, so accredited and qualified. So there are two standards. One is RICS and the other one is Arla. And you should really be looking for a management company that's got one of those two badges, just as a sign of quality, as it were. So where to invest, what to do. Got a few tips around that, which I'm going to share with you. Firstly, there are a lot of safety regulations. If you go into those and you position yourself in those 3, 4, 5 bedroom, that 3, 4, 5 bedroom sector, then what you find is that the amateur landlords are really deterred. So you will find there's a shortage of supply and there's a lot of demand from tenants for that sector. So we favour that particular sector. Secondly, I prefer big cities because they've got big universities, they've got big populations, and there's very high rental demand. So that kind of makes good sense as well. And then students are obviously a very large market. We talked about students before, but there's also safety in numbers, because from an investor point of view, what you have is each tenant, so let's say a group of 3 or 4 tenants renting, let's say 4 tenants renting a 4-bedroom house or flat, then every one of them is individually responsible for their own rent, but they're also collectively responsible for all of the rent. So if one person defaults, then there's lots of recourse against the other tenants. And also with students in particular, there are, behind every student there's a guarantor, usually a parent. So again, when there's some kind of a rental issue, Lord forbid, then you've got lots of people to go after. And conversely, a 1-bedroom flat will probably have a young professional in it. If their circumstances change, then bottom line is that they may well decide that they're just going to leave and they've lost their job, leave town, etc. You've got very little recourse. You've got to find that one person and chase that one person to get the money. So I like the student market and I like the larger flats. So if you go for a traditional property, as we've explained, then you've got the best of the new build world, because you've got a brand new interior following our kind of model, and you've got the traditional building, which has higher ceilings, bigger rooms and so on. And there's an interesting situation at the moment whereby we cover both Scotland and England, but in Scotland, generally speaking, the occupancy and the rent levels are higher than England, and that's really to do with the regulations and so on that there are around safety being much stricter in Scotland. So it's interesting to look at the Scottish, but we can cover England and English and Scottish cities. But there's some other factors as well, because in Scotland there are no tuition fees at university, and there are rising rents, and all of that means that basically the Scottish cities do perform particularly well. So personally, I would put most of my money into Scotland and a bit of my money into England as a hedge. This slide here gives you an idea of some of the locations we're in. So we've got some English ones and some Scottish ones. We're going to be adding Manchester to this again very shortly. But basically you get different cities. So I'll bundle a couple together. So if you take Edinburgh and Glasgow, for example, then a large city with a big population, big universities, we tend to buy in the range of 200 to 300,000 in the good areas in those cities. The yields tend to be 6% or thereabouts, sometimes a little bit more. Then you get other cities such as Dundee and Stirling. I'll highlight those two. They might be shadowed by some of the English ones as well, but these are quite interesting because they're smaller cities, still with good sized universities, and they generally have got higher yields. So it tends to be 7, 8 and sometimes even 9% yields. So if you're very yields focused, you might look at those cities over Edinburgh and Glasgow. Dundee, just to highlight it, is really quite interesting because there's a £1 billion regeneration programme going on in Dundee, and it's also about 10 miles away, I think 10 or 12 miles away from St Andrews, so everyone knows about St Andrews. So Dundee kind of gets the overspill, both in terms of students that can't get accommodation in St Andrews, because it's actually a small village. So we get a lot of overspill in Dundee from even St Andrews students. And also there's no nightlife in St Andrews apparently after about 10 o'clock at night, so they all go to Dundee as well. So that's one to put in on your map there. And then Nottingham and Bristol are probably the two best cities that I think there are in England right now in terms of occupancy and yield. And because we're with clients for the long run, we don't want to lead you down the garden path of going to another city. So these are the ones we're most comfortable with in England right now. We can give you, and we would want to put you in touch with clients who have invested with us, because if you don't know us, then it's a great way to not just hear our story, but then also speak to some clients who've experienced what we do. So no problem with that. We've got hundreds of clients we can connect you to wherever you're based around the world. To summarise all that then, the rental market is very, very strong. Property prices are rising, so it's actually a great time in the cycle to invest in the UK, which is good. And our strong recommendation would be to focus on traditional property in a good area. That would be the real way to go. If you want to progress things and you want to work with us, then the next steps there would be that we would ask you to help us understand what it is you're trying to achieve, and if we can help you, absolutely will. So what your preferences are in terms of cities, in terms of locations, in terms of your budget, etc. And the better an idea we have of what you're looking for, the better a job we can do in matching you up with properties that we've identified that might work. The second thing we do is to connect you to a lawyer, to a bank if required, and also to an existing client, because why not speak to someone who has been with us and experienced it right the way through the cycle, as it were. And the third thing is really to get your investment ready so that you can take a decision quickly, because when a property comes along and you like it, then given the competitive market, we can get gazumped, but equally, you can end up losing a property that you like because you're just taking a bit too long, if you don't mind me saying. So being able to take a decision quickly is really good, and whether it's a yes or a no, it doesn't matter. If it's a no, we can refine our brief and put something else forward and get it right. And these finally are some things which I'll just leave with you. They're the frequently asked questions we have, which we'll just leave you with to look at. So thank you very much indeed for your time. Hopefully it's been of interest and relevance, and look forward to working with you.